Good evening, friends. Welcome to our evening lecture on revision of the paper of CA Final Indirect Taxes. Now, until the previous class, we completed the various provisions which deals with the GST law. And today we are starting with the provisions dealing with the customs law. Now, students, you have to remember and understand one thing, that customs law is unique and very different from our other taxation laws. Reason one, that custom law is dealing with international transactions only, and it is the law which is made for taxing what is going out of India and what is coming into India. Point number two, since it is dealing with international transaction, it has to be in line, in consonance with multiple international policies, international regulations. Thirdly, customs law covers only goods. It is not covering service, because only what can physically come into India and physically go out of India is part of customs law. Fourthly, as far as customs is concerned, what is interesting to note is it is a law which not only collects the customs duty but also collects other local taxes and duties. So it operates as a single window system. So these are some very special and unique features about the customs law, which make it different and stands it out as compared to other taxation laws. Now, it is very important to understand the very essence of the custom law, that is the charging section. Now, as we discussed, this law is applicable only for the physical coming in and going out of goods. So it levies the customs duty on goods which are imported into or exported from India. So it will not cover goods which are not traveling outside India or coming from a place outside to inside India. Second important thing, the Act is not providing the rates. The rates are provided in a separate law, that is the Customs Tariff Act. So Customs Act is only for the substantive provisions, and the rates are covered in a separate law. Also, the provisions of custom will apply equally to government goods. So they have kept government and private at par. Now, from the charging section, what we can make out is the taxable event is import or export. Now, here comes a very interesting point. Now, as far as exports are concerned, exports is defined to mean where the goods cross the territorial waters of India, that is, it is taken outside India to a place outside. Anyways, our intention is not to tax exports. We are only covering exports in this law so that we can have a better control regulation, and for a very few goods, which you can call as the goods where the government do not want to promote exports, have been levied with export duty. Mainly export are for the export is defined in the law and it's covered in the law from the perspective of the varied benefits that an exporter can get because of export of goods. Now, when it comes to import, which is the major taxing element in the customs law, an interesting practical issue that arose in import is defined to mean bringing into India from a place outside. And when you see the definition of India, which you study in customs law, in your GST law and other laws, India is defined to mean not only the land portion of India, but also the 12 nautical miles into the sea, which is our territorial boundary or territorial waters. Plus, India extends into the air, which is the airspace of India. Now, when you read or when you come across this comprehensive definition of India, then comes the most practical challenge as to how will I determine whether import has happened or not, because import is coming into India, that is crossing the territory line of India, which is an imaginary line in the sea plus imaginary line in the air. Hence, practically implementing duty of import was very difficult, and there were some judgments which even made out a very special issue relating to this. Hence, on all the basis of those judgment, which includes the Garden Silk Mills case, the Kiran Silk Saris case, in all these cases, the Honorable Apex Court brought out a very important practical, you can say, charging section whereby the Honorable Court said that import will start when the goods will come into this imaginary border of India, but the liability to pay will not trigger at that point. It will trigger when the goods are finally cleared. Now, this is what is the practical charging point in case of import. That is, when the importer files bill of entry for clearing the goods from the customs, that is taking the goods in his custody, taking the goods to his factory and making the goods usable for his business, that is the point where the liability to pay import duty would trigger. So, in case of import, the taxable event will happen when the goods are cleared for home consumption. That is, they are cleared from the customs by the importer by filing the bill of entry. Now, customs law also provides a special provision which we are going to study in later chapter, that is of warehousing. So, so an importer who has imported goods may not require the entire import goods immediately. So the warehousing provisions of customs give a relaxation in time whereby the importer need not pay the entire customs duty today. The importer has to file a bill of entry, which is bill of entry for warehousing, which is also called as into bond bill of entry, and request that the goods be kept in customs bonded warehouses. And then later, whenever the importer wants the entire quantity or part quantity, would file another bill of entry, which will now be called as X bond bill of entry for clearing the goods from the warehouse. And again, the final taxable event will reach when the goods are cleared from the warehouse, that is cleared from the customs. So ultimately, you can say the final taxable event in case of imports is clearing the goods from customs and not merely bringing into India. There are some important terms that you need to keep in mind. So Indian custom water means the water extending into the sea up to the limits of EEZ and includes any bay, gulf, harbor, creek, etc. That is the extent up to which the powers of custom officer lie. Just a minute, student. So that is what is the meaning of Indian custom waters. That is the waters in which the custom officers can exercise their powers. The other term is the territorial waters, which I was referring to, which is up to 12 nautical miles into the sea from the baseline. This is what is our territorial and political boundary of India. Then comes exclusive economic zone. This area is beyond the territorial waters and it extends into the sea up to 200 nautical miles from the baseline. And the area beyond this EEZ is the high seas. Now, what is the impact or the purpose of this EEZ? When we say EEZ is 200 nautical miles into the sea, that does not makes it India. So EEZ is not India. However, with international consent, this area is allowed for some specific economic activity like exploration of crude oil if there are crude oil reserves. So that is what is the limited purpose for which this area can be used by India and which is allowed as per international rules and regulations. That is why it is called as exclusive economic zone. So for taxation purposes, this particular area will have a lot of relevance because there will be some economic activity happening over there. But otherwise, for all purposes, it is not considered as India. Now comes the customs tariff act. If you remember the charging section, what we saw above, the charging section said that the rates of the customs duty are provided in the separate act called as the customs tariff act. Now this act has two parts or two schedules. First schedule deals with the import duty and the second schedule deals with the export duty. Now, besides the main charging section, that is section 12, you need to remember for the purpose of your exams the special circumstances in which the duty is either levied or the duty is given as a concession, as an abatement, because these are the ones which becomes important for your exams. Now, first, special circumstances, re-importation of goods. Now, what is this special circumstance? Let us first understand that and then see the tax consequence. So exported your goods. So let us say you got some export order and against that you exported your goods. However, these goods are returned back. So what you had exported have come back, but why they have come back? For repairs or some type of correction. And you are going to carry out that repairs rectification and then re-export it. So where such goods are coming, which you were originally exported by you, but are brought back to India, in such cases, firstly, it is important to note that the customs law does not treat these goods as different. It says that these goods would be treated at par with other imported goods. So firstly, because of this specific provision, the entire custom law looks at these goods as your regular imported goods. However, what is special over here is by way of this notification, they have said that you need not pay the entire customs duty on these goods against. What you have to do is simply whatever incentives we had given to you because you had originally exported the goods, you return back those incentives that will be treated as your import duty. So the import duty payable on such goods is nothing but the amount of incentive, subsidies, whatever we had extended to you at the time of export. Next, in this case, in case of point 4, that is where the goods are imported under a duty exemption scheme, the amount of IGST and compensation cess will be leviable at the time and place of importation of such goods. Now see, these are the various schemes or benefits which you may have utilized at the time of export. Then comes the second category, goods other than those falling under serial number 1 exported for repairs abroad. Now, what is the second scenario? Now, here you had originally sent the goods outside for getting repaired and getting back the goods. So here you had yourself sent a machinery, some capital goods, which you want some repairs to be done, which can be done only outside. And after repairs, their goods will come back to India. Again, in this case, though as per the basic provision of the law, these are also to be treated at par with imported goods, but you will understand that these are not fresh goods. These are your own goods which you had originally sent for getting some repair work done and now they are coming back. So in this case, what does the notification says? You don't have to pay the entire customs duty on the full value. Rather, you pay the customs duty with all its component like BCD, IGST, if applicable, GST compensation says on only the repairs portion. So whatever is the cost of repairs that is incurred outside, on that you will have to pay the basic customs duty. Now there is some clarification that firstly, the cost of repairs will include the materials, parts, any type of replacements done in your machine. So whatever new parts are added at the time of repairs, value of that is also to be considered. Plus whatever is your insurance and freight charges both ways while sending the goods and returning back, that will also be added on this total value. You will calculate the customs duty and not on the full value of your machine. And the third scenario is goods other than falling under serial number 1 and 2. So it will cover those goods which, let us say, you had sent for exhibition purposes and after the completion of exhibition they are coming back, or the goods which you had sold are now not required over there, so the sale is cancelled, hence they are rejected and returned back. In such cases, they are saying import duty will be nil. Now, what are the conditions to be satisfied for claiming the above benefit? So above notification, has reduced your custom duty only to the extent of some very lower amount, which will be in first case the amount of export benefits, and in the second case custom duty on the repair portion. Now to get this benefit, what are the conditions that you have to satisfy? First, time limit for reimportation. So to get back the goods, you are given 5 years, that whatever you had exported should come back within 5 years. This can be extended by further 2 years, and 7 years, which can be extended by further 3 years in case you had sent plant or machinery to Bhutan. Next, in case of goods which are exported under these special schemes like advance authorization, duty free, or EPCG, then it is 1 year and further extendable by 1 more year. Second is the same goods should have come and you are returning back, re-exporting the same goods. And most important, you remain the owner of the goods always. There is no change in ownership. It means in between this, you have not sold the goods to anybody else. Then comes the second relaxation notification. It says what? Exemption to re-import of goods and parts thereof for repairs, reconditioning, processing, remaking, or similar other process. So, goods which were manufactured in India are re-imported for repairs, reconditioning other than specified goods. Now, time limit for re-importation, they should come back to India within 3 years, and in case of export to Nepal, Bhutan, within 10 years. Goods manufactured in India and re-imported for reprocessing, refining, remaking, or similar process, it should come back to India in 1 year. Now, what are the conditions to be satisfied? You should resend them within 6 months. So you had brought them for repairs, after repairs, and now resending is within 6 months, or extendable in 1 year from the date of its reimportation. Second, the ACDC of the customer is satisfied as regards the identity, and you have to cover the entire transaction using a bond to ensure that there is no duty leakage. Now, so this was the first scenario, which let us call it as reimportation. Now we come to the second special scenario, which is goods derelict, wreck, jetsam, flotsam. Now, what are these goods? Now, interestingly, it may happen that nobody from outside has sent the goods, but still the goods have reached India. How? The goods were floating in the sea and you collected them. Or the goods with the tides have come to the seashore. Or there was a ship which is in the high sea and it found goods which were abandoned over there because some ship was sinking, or the goods had sunk, and this ship is bringing those goods. So in short, these are those goods which nobody has exported to you in India, but you have found it either in the sea or it has come to the seashore. So these may be goods which are thrown by someone in the sea to save their ship from sinking. These goods may be the goods where some ship has met with an accident and the ship has drowned, and the goods are either floating or they are also drowned. So these goods are called as goods which are derelict, jetsam, flotsam, or wreck. Now, either you found it in the sea and you are bringing it into India, or by seas tides, it is automatically coming to India. The law says we will treat it at par with normal imported goods. So again, these goods which nobody has sent to India, but still you are bringing it into India, they will be treated at par with imported goods. It means all tax incidents will be same on these goods. If these goods are leviable to customs duty, they will be leviable. If these are exempt, they will be exempt, unless it is shown to the satisfaction of the proper officer that they are entitled to be admitted duty free. Now, when this will happen, when you can prove that these were goods which you had taken outside and now you are bringing back, only then they can be allowed duty free. Otherwise, they will be treated at par. Now we come to the most important point. If I have to explain this point in the language of GST, in the language of GST, this is time of supply, which means what? The date on which the duty liability triggers. So like GST, the taxable event is supply. Now supply happened, but there are different dates relating to a supply. Out of that, which date will be taken for finding out the rate? Which date will be taken for deciding that, okay, this is the taxable date, and now accordingly in the monthly return, you cover this transaction and pay the tax, which is called as time of supply under GST. Similarly, in customs, what will be the relevant date for determining the rate of duty and tariff value? In short, the time of supply under customs. Now, what does Section 15 provides? Section 15 says that where the goods were imported to India and the importer immediately filed bill of entry for home consumption, means he did not go for warehousing. In such cases, what is the relevant date? Which date's rate you will consider for computing the customs duty? Answer is the date on which the importer had presented the bill of entry or the date on which the ship was given entry inwards permission, whichever is later. Now, what is entry inwards and all? You study in another chapter when we will deal with the import-export procedures. So, when the goods were imported to India and immediately they were cleared by the importer, the relevant date for determining the customs rate and custom value will be later of both these dates. However, where you had warehoused the goods, so goods were imported, they were not immediately cleared, they were cleared for keeping it in warehouse, and now from warehouse they are getting finally cleared. It is the second bill of entry which you file. I had mentioned that first you had filed bill of entry for depositing the goods in warehouse, and then later, whenever you need it, you file the bill of entry for removing it from warehouse, that is bill of entry for home consumption. That is the relevant date. And then last comes any other goods which are not falling over here, like for example, goods which are auctioned, etc. The relevant date is the date on which the duty is actually paid. Now, again, some more special situations. Duty on pilfered goods. Now, what are pilfered goods? Pilferage means petty thefts. So, when you import goods, the procedure which we'll study later in brief is goods are first kept with a custodian who is generally the Port Trust Authority of India, and then the bill of entry filed by importer, assessment done, duty payment done. The importer clears the goods from this Port Trust Authority. Now, between this period, that is a period of importation and final clearance by the importer, there is a possibility that there could be some petty thefts. What is petty theft? Let us say you had imported a carton containing 10 pieces. So the carton is intact. The entire carton is not gone, but few pieces from the carton is missing. This is what is called as pilferage. Now, what does section 13 says? The conditions, students, please mark these conditions specifically from what date to what date the pilferage happens, then section 13 applies. It is that the pilferage has happened after its unloading and before the clearance order for its home consumption or deposit in warehouse is passed. That is, in short, while the time the goods were kept with the custodian. If in this period the goods were pilfered, then importer is relieved from paying duty on those quantities which are pilfered. Yes, the government collect from the custodian, but you are excluded. That is what is the relief given. Further, the section says that in case later on the goods are restored back, so let us say police action has happened and they find the culprit and the goods are restored back, then you will have to pay the duty. So if goods are restored back to the importer, then the importer has to pay the duty. Now comes the second concession. Now, first concession was that out of the entire carton, few pieces are missing, which is pilferage. Now, what if the entire carton is lost? So now we are talking about goods which are completely lost or goods which were destroyed, or the customs allow the importer to abandon the goods. Now, lost means your entire boxes, entire carton is missing. Destroyed means there is some destruction of the goods, maybe because of any climatic conditions, or there is any some accident which has caused the damage and destruction of your goods. And last, goods which you have rejected. So as importer, you imported some goods, but when you went for inspecting the goods at the port, you found that some wrong goods have come. So you have rejected the good. This is abandoned. Now, in all these three cases, what is important to be noticed now, the entire goods are gone. Either entire is lost or entire is destroyed or you have abandoned them. In such cases, the law says we will remit the duty. That is, you will not be required to pay the duty at all, provided the imported goods are completely lost or destroyed when at any time before clearance. Now, here the time limit is much wider than the previous pilferage case. So, any time, right from its loading in the foreign country till its clearance in India, if at any point of time the goods are lost, destroyed, abandoned, this section 23(1) gives you the relaxation that the entire duty on the goods will be remitted, that is waived. Now in this, as we are discussing, that if after import you find that the goods are not as per your desired quality or specification, you are given the power to abandon the goods. Now, what does section 23(2) says? So owner of imported goods may relinquish his title to the good. That is, he may say that I don't want these goods because these are not the goods which I had ordered. When anytime before an order for clearance of home consumption or order permitting the deposit in the warehouse is passed. So before the goods are finally cleared in favor of the importer, if any time before that the importer waives his rights over the goods, waives his title over the goods, the law says we will remit the entire duty and no duty will be payable by the importer. However, relinquishment of title will not be allowed when the goods have been found to have committed any offense. So let us say you are trying to import prohibited goods, and now you got to know that the customs are checking your parcel and there is a risk that you will be caught. So now you say that, okay, I am rejecting the goods. Then such abandonment is not allowed. So relinquishment will not be allowed where the goods have been under some offense. Now, similar to this 23, you have one more concession relaxation in 22. Now, 23, the previous section was complete waiver of duty. 22 is partial waiver. Now, when does 22 applies? When your entire goods are not lost. Your goods are there, but they are in a damaged condition or they have deteriorated because of natural reasons. So let us say your entire goods are not lost or they are not entirely destroyed, but there is some slight breakage. There is some slight damage because of which now your goods have deteriorated in its value. So let us say you imported some natural products, some fruits, and because of long travel and storage time, some of the uh, let us say mangoes which you have ordered and imported have started deteriorating. Now you know that these will not fetch you the complete value. Now, when any such thing happens, again, what is the condition? Any imported goods before or during the unloading, any imported goods other than warehouse goods by accident after unloading, but before its examination. And third situation, which is for warehouse goods by accident in warehouse, but before their actual clearance from warehouse. So this condition, this section extends up to the clearance from warehouse also. So if at any point of time here, the goods have got deteriorated or damaged, and most important, the accident which has caused this damage is not because of your fault or your negligence. So you are not involved in this accident. It means it has happened beyond your control. Then they are saying we will abate, we will reduce your duty proportionately. Proportionate to what? Proportionate to how much is now the value of the damaged goods divided by how much is the value of the original goods. So let us say my mangoes originally would have valued 500 rupees. Now because of damage, I will get only 200 rupees. So 200 upon 500, to this extent, that is to the extent to which my value has reduced, they say we will also reduce your custom duty. So custom duty will be proportionately waived. Now, how to determine the value of these damaged goods? So one, it may be determined as per the ascertainment of the officer, or you can sell it in public by way of auction tender, and whatever price actually realizes, this is how you will determine the value of the damaged goods. Now, a comparison between all the three sections, because all three are giving you benefit. So first is 13, which gives waiver only of the pilfered portion of the goods. Second, 22, which we just saw last, which says that we'll proportionally reduce the goods, reduce the duty on the damaged goods. And third, remission or loss, where the entire goods are lost, we will give you remission of the goods which are completely lost or destroyed. Now, there is another interesting situation which is covered in section 24, which deals with denaturing. of goods or mutilation of goods. What is denaturing? So let us say I have imported milk, which can be used for multiple purposes. But now, because of some reason, it is now getting deteriorated, damage. So with the permission of customs, I have converted it into paneer to avoid the complete loss. Now, in this case, I have denatured the goods. I have changed the nature whereby the goods which were earlier capable of multiple uses are now not fit for all the uses. They can be now used for one particular thing. So you can understand what I had imported was milk which can be used for multiple purposes. But I have denatured it, obviously, with the permission of customs and made it into paneer or made it into curd. Now, in this case, the purpose for which this now goods I am having is limited only to a particular purpose. This is denaturing or mutilation. Now, in this particular case, how the duty will be computed? So they are saying after denaturing, goods can be used only for one purpose, and accordingly, the duty will be leviable. So, in short, the duty will be leviable as per the new goods after denaturing and not the original goods. Then comes student section 25, which deals with exemption from custom duty. Now you'll find that this is sounding very similar to our GST exemption. So again, like GST, there are two categories of exemption, general and special. General, where the government feels that it is in public interest to give exemption, it will by way of notification either grant general exemption, which may be absolute or conditional, and conditional exemption valid up to 31st day of March, falling immediately after 2 years from the date of grant of such uh, conditional exemption. Then comes special exemption, again, where the government feels that it is in the public interest to do, will pass a special order and will grant exemption only in a particular situation to a particular person. That is what is special. Now, since this is given to a particular person, the government has to satisfy that there is circumstances of exceptional nature why that exemption is required. No duty if the amount of duty leviable is equal to or less than 100. Fine. Now, comes the important point. What is the date on which the notification will be treated as effective or applicable? So answer is, first is the date of its issue by the central government. So whenever the government issues, they put a date in the notification, that is the effective date. Second, wherever it is by way of a special order, again it is the date of its issue. Now let us say after issuing this notification or order, after that the government wants to bring some clarification. So they may add some clarification explanation in the original notification. Now, obviously this is happening at a later date. Now the question is, from which date this explanation becomes applicable? From the date of original notification or the date when this explanation was actually added? So they are saying, if you give this clarification within 1 year from the date of original notification issue, we will consider it as applicable retrospectively. That is the date of original notification. If it is given after 1 year, it will be applicable prospectively from the date when this clarification is added. Next comes exemption from custom duty on imported goods used for inward processing of goods or re-imported goods used for outward processing. So when goods are imported in this particular manner, either for inward processing of goods or re-imported goods for outward processing, then section 25B is giving exemption. What is the purpose? The purpose is repair, further process, manufacture. So it should come in 1 year time limit. It should be identified with the previous goods, and there are other conditions. If all these are satisfied, you get the exemption. Fine. Let us take up few questions for better understanding of this particular point. So I'm taking up question 2. So Messrs XYZ 100% EOU imported DG set and furnace oil free for setting up captive power plant for its power requirements for export production. This benefit was available via notification. They used the power so generated for export production but sold surplus power in domestic tariff as power could not be stored. So there is a EOU which imported some machinery which is used for producing electricity. And what they are doing is they are using this DG set for the production of electricity in their factory. And whatever is the excess electricity produced, they have sold it in the domestic market. Now, custom department has demanded duty on the DG set as surplus power has been sold in the domestic area. So they are saying since you are 100% UU, you should have exported all your goods. But the power generated with this DG set, which we have allowed you to import free means without duty, you are using it by selling it in domestic area. Now, the notification does not contain specific restriction that the imported goods can only be used for manufacture of export goods. Now, this is a point in the notification. Now, the question is, do you think that this demand by the customs department is valid? So see how you write the answer. Now, the facts of this case are similar to a case law, which is of Commissioner versus Hanil Era Textiles, wherein the Honorable Supreme Court has agreed to the view taken by the tribunal that in the absence of a restrictive clause in the notification, that imported goods should be used exclusively for manufacture of export goods. Hence, there is no violation. And since there is no violation because there was no such restriction, whatever surplus power is generated is sold in the domestic area, there is no duty that can be demanded from XYZ for such power which is sold. So student, this is how you will answer this. Now this question was linked to a very specific case law. So you have to read the entire module so that you get to know what are the specific case laws on different issues. Let us proceed. Now we come to the second chapter of our module from customs section. This chapter deals with the types of customs duty. Now again, if you go back to our charging section, which we studied in the previous chapter, section 12, it is saying that duties of customs will be levied. And interestingly, it says that it will be at the rate specified either under the Customs Tariff Act or under any other law for the time being in force. Now, go back to our section 5 of the IGST Act. If you remember that in section 5 of the IGST Act, which is a charging provision of IGST, there is a proviso which says that the IGST on imported goods will be levied, collected, time of supply, valuation, everything will be as per the customs law. And this is what I had also mentioned at the start, that customs law is very unique because it is acting as a single window system, because it is not only collecting the customs duty, but also the other local taxes and duties, if any, leviable on the same goods. Now, on this point, what we understand is that there could be different duties which are levied and collected on imported goods. Now, majority of them, which we are going to study over here, are part of the customs only. Within customs also, you have multiple types of duties. Besides that, we have the IGST, which is leviable on supply, that is also collected along with the customs duty. So let us understand all the types of duties which are leviable on imported goods. So what we are studying is the first duty, which is the basic custom duty. So it is levied as per the charging section of Customs Act, that is section 12, read with section 2 of the Customs Tariff Act. Now, two types of basic customs duty. One is on export goods, which will be as per Schedule 2, and one is on goods imported, which is as per Schedule 1. So section 2 of the Customs Tariff Act says that for rate of customs duty, you have to go to respective schedules. Now, Section 3 bracket 7 of the same Customs Tariff Act says that in addition to the basic custom duty, what will also be levied on the imported goods is the IGST. That is, the GST component will also be levied and collected through the customs law. And Section 3 bracket 7 of the Customs Tariff Act makes a specific provision. It also refers to the charging section of the IGST Act, because I was just explaining that the proviso to this charging section has already mentioned this, that the duty, that is IGST, on import of goods will be collected by the customs. Now, this IGST is collected under section 3 bracket 7. Rate of IGST will be not decided by customs. It is the rate which we have already decided in our GST related rate notification. The rate maximum we all know cannot exceed 40. Actual rate you will find which may be 18, which may be 40, which may be 5, which may be 0 as per our rate notification. Now, what is the manner of computing the assessable value? Now, interestingly, For the purpose of levying or computing the basic custom duty, you take the value as determined by the customs law, which is under section 14, read with the valuation rules, which we are going to study today. So first comes the assessable value under customs as per section 14, read with the valuation rules. Now, on this value, you compute the basic custom duty and the custom welfare cess. Now, you add up all this, that is the assessable value, you add up basic custom duty, the custom welfare cess, and if there are any other additional custom duties, various protective duties, which we are going to study in this chapter later, all those duties are to be added, and this total amount which you get, that is assessable value under customs plus basic custom duty, custom welfare cess, and all other duties leviable under customs except obviously the GST. This total is the assessable value for computing your IGST. Now, if you connect it with the GST law, so in GST law, section 15 of the GST law also says something similar. It says that for the purpose of computing GST, you will add up all other duties and taxes, if any, levied on the goods. Same thing we are doing over here. So for computing the IGST on imported goods, we are adding the basic custom duty plus all other duties which are leviable under customs except the GST duty. Adding up all this will be giving us the assessable value on which you'll multiply the IGST rate. And if there is compensation cess, you'll multiply the compensation cess rate. Then come, students, the next point. What will happen if your goods are leviable with some special custom duties like anti-dumping duty, safeguard duty? The answer is the value for calculating IGST will be including all these duties. So as I explained above, any duty other than GST has to be added, and on that total, we compute the IGST, that is the GST component on imported goods. Now comes the second point, how to compute value of the goods which were originally deposited in warehouse, and now you are going to clear it from the warehouse. Now here, firstly, the first value that is to be taken is your assessable value as per custom section 14. Add it, add to that basic custom duty, add to that any other sum leviable under any law for the time being in force, and exclude GST because we have to compute GST. So in short, the same value which we studied above. But this value will be compared with transaction value and we'll take whichever is higher. Now you'll say, sir, what is this transaction value? So it may happen that while these goods are stored in the warehouse, the original importer has already sold this to somebody else. Now, who is going to the warehouse and clearing is the second person, not the original importer. Now, in this case, for the second person, this is his purchase value. So what is the sale value for the original importer is my purchase value. So these two values will be compared. Firstly, the value which we discussed above also compared with the final last transaction value, and whichever is higher of these two values will be taken for computing the IGST on these imported goods. Now, as I was saying, in customs, there is a customs social welfare surcharge. It is always to be levied at the rate of 10%, but 10% not of the value of the basic customs duty. So it is 10% of duty. So it is same like our surcharge, what we have studied in income tax, where the amount of surcharge is calculated by multiplying the surcharge rate by the basic income tax amount, not the income amount. Same thing over here. The welfare surcharge of customs is calculated by multiplying 10%, which is the fixed surcharge rate, to the basic custom duty and not the value. Again, this is levied and collected on the imported goods. Now, while computing this 10%, you will not consider other taxes and duties. It means this is computed exclusively on the basic customs duty. So including IGST, GST compensation cess, everything is excluded. It will not be covered for the purpose of computing that 10%. Now, the Customs Tariff Act. Now we all understand that whenever you say act is something which is passed by the parliament. It means the customs duty rate which are given in the Customs Tariff Act are all fixed by the parliament and can be changed by the parliament only. However, we all know parliament is not functioning 365 days. Right now we have the monsoon session going on. After 13th of August, this parliament will close and it will again resume in December, which will be the winter session. Again, after 1 month of working, it will close and it will resume again in February for budget. So our parliament is working in sessions. Now, what if between this period of 2 sessions, something happens and some emergency action is to be taken? At that time, you cannot ask the parliament to come and then do the discussion. Hence, emergency powers are given to the government for the time being. Two powers. One is in Section 8 and the other one is in 8A. 8 is dealing with powers to impose or enhance the export duty, and 8A is for import duties. Now, what does Section 8 says? Central government is empowered that it can bring an amendment to the second schedule by way of a notification. So you all know export duty rates are given in second schedule. So this second schedule can be amended by the central government. Please understand that talking about amending an act, which can be only done by parliament, but this is a extraordinary power because it is to be used only in case of emergency. Most important, the goods may or may not be originally included in the second schedule, and the government will have to prove that it was necessary to do it on this emergency basis. So using this emergency power, the government can on its own either impose or enhance the export duties. And most important, one of the condition is that whenever the parliament will be in function, government will have to get it approved and ratified. But for the time being, they are given the emergency powers. Then comes the emergency power to impose or enhance import duties. Again, same central government can import or enhance by amending the first schedule. Again, this will be done by passing a notification. Again, the goods should have been specified in the first schedule. What is the difference between these two emergency powers? In case of export duty, even if the goods were not originally specified in the second schedule, emergency power can be used to add a new commodity in the export schedule. But for import, the commodity should already be present in the first schedule. You cannot add a new commodity using your emergency power. This is very important difference to be noted. Again, you have to prove that it was necessary to do it. There was such emergency situation why the government decided to bring in the change. Again, this change has to be approved whenever the parliament resumes. Now coming to some other duties of customs. So we have studied basic custom duty, we have studied the customs social welfare surcharge or cess, and we have studied the IGST. Now we come to some other duties which are custom duties only. Now these are also called as protective duties. Why? Because they are levied in situations where the government feels that huge importation is affecting or has already affected or may affect our industries, our economy. So to protect them, the government is empowered to impose these protective duties. Now, in these protective duties, the first one is under Section 8B, which is the safeguard duty. What is this safeguard duty? Again, as the name suggests, it is for safeguarding our industries. Against what? Against any import which is in increased quantity. So if any article commodity is suddenly imported in huge quantity and it is causing or threatening to cause serious injury to our domestic industry, then the central government will set up an inquiry commission, and on the basis of the inquiry commission's report, it will impose safeguard duty by way of a notification. Now, what are the modes? So, imposition of safeguard duty or application of tariff rate quota or other measures as the government deems appropriate. So, either it will bring in a duty or it may set up a quota up to which a person can import. First option. Second point is this duty can be initially imposed for 4 years, and after 4 years, if it is proven that the damage is still being caused and the industry needs some more time to revive, they may extend this by further 6 years. That is, in total, the safeguard duty can be levied for 10 years. Interestingly, until the time the inquiry is going on, because as we saw above, the government will conduct inquiry and then decide whether to impose this or not. But if during that period huge imports are happening, the government is also given power to impose this safeguard duty on provisional basis. so that until this inquiry is completed and government comes to a final conclusion, it should not happen that huge import has already happened. So they can impose a provisional safeguard duty, and after the inquiry is complete, if it is decided that yes, duty should have been levied, they have already levied. If it is decided no, duty should not have been levied, they will refund the amount. This safeguard duty on provisional basis can be levied up to maximum 200 days. In short, within 200 days, the government should complete their inquiry and finalize. Next, exemption. Now, certain imports are excluded from the levy of this safeguard duty first, where the goods are coming from developing countries and the share of single developing country is not more than 3% of our total imports, and where they are coming from more than one developing country, then share of each country does not exceed 3%, and share of all the countries combined, all developing countries combined, does not exceed 9%. So up to 3% per country, sorry, and up to 9% in aggregate, we will not levy safeguard duty, but beyond 9%, even if the goods are coming from these developing countries, we will levy the safeguard duty. Next, imports by 100% export-oriented undertakings or by SEZs are not leviable to this safeguard duty. Then comes the second protective duty, which is called as anti-dumping duty. Now, what is dumping? Students, dumping is that situation where a businessman sitting outside India is purposely lowering the cost and sending the goods to India at a very cheap rate. But what is important to be established is that the export price, that is the price at which it is sending the goods to India, is lower than the normal price of these goods in their own country. So let us say in their own country, they are selling the goods for 100, which is the normal price in their country. But when they are sending the goods to India, they are only sending it and charging 40. So this is a point of concern. It means you are intentionally lowering the price, because if your goods are really cheap, you should have sold that in your country also at 40 rupees. But in your country, it is being sold at 100. And when you are sending to India, exporting to India, you are charging 40. Now, how is anti-dumping duty computed? It will be lower of injury margin or margin of dumping. What is injury margin? It is the normal value minus the export price. This is what is the margin of dumping. Now, how to find out normal value? Comparable price at which the goods under complaint are sold in the domestic market of the exporting country. So, in the country of export, these goods are sold. Then what is the price over there? That becomes a normal value. If normal value cannot be determined as per the sales in domestic market, why? Because maybe that country is not selling the goods in their own market. Then comparable representative export price to an appropriate third country. So now here normal price is the price at which they are exporting it to any other country. So it may happen that when they are exporting to US, they are charging the normal price there. That is their full price. But the same goods, when they are sending to India, they are pricing it lower. So in this case, the price at which the goods are exported to US will become your normal price and comparable price. If that is also not possible, then cost of production in the country of origin plus administrative, selling and general costs. So we will do the costing, and through costing, we'll try to determine the normal price. What is the export price? It is the price at which these articles are exported to India. Now, how to find out injury margin? Because one is the dumping margin. So dumping margin is normal price in their country minus export price. How to find out injury margin? It is the difference between the landed value of these dumped goods and the fair selling price, that is the non-injurious price due to the domestic industry. So price at which these goods are landing in India, and what is the price which our industries can absorb. So what is the fair price for our industry? So let us say our industries are manufacturing and selling pencil cell for rupees 12 per piece, but China has sent a pencil cell which is only for rupees 4, and after adding all duties, etc., all cost, it is landing at 6 rupees. So the difference between this is the injury margin. How to compute landed value? It is the assessable value under customs and applicable BCD except special duties. So your assessable value plus basic custom duty is your landed value. Now, there is one more special duty, protective duty, that is countervailing duty on subsidized articles. Now, what is this? It may happen that, now see, it will appear similar to dumping, because what is common between dumping and this is that the goods are priced higher in the own country of origin, but they are priced lower when they are sent to India. So as I was giving example, in your own country, it is sold at 100, but when you are exporting it to India, you are sending at 40. Now, one reason of this could be that the businessman himself has reduced the price purposefully, which is called as dumping. Second reason why 100 has become 40, because maybe the manufacturer or owner of the goods is not reducing the price, but government, their country's government, has given lot of subsidy when those articles are manufactured and exported, like how our country government also does. Now, this will make the export price of those goods cheaper, because on the export, they are getting all the subsidies, cashback, cash incentives. So that is lowering their cost or price of export. So when the government of the foreign country is giving subsidy on the articles, because of which such articles are exported to India at a lower price as compared to what they are sold in their own country, then this is considered as suitable for levying this not anti, sorry, countervailing duty on subsidized articles. Now, how much can be your countervailing duty? It should not exceed the amount of subsidy which that foreign country government has paid. Now, what are the common provisions relating to countervailing duty and also anti-dumping duty? First, both can be levied initially for 5 years and then extended by further 5 years. So in total, 10 years. Next, people may try to circumvent the duty. How? By altering the description, name, composition, or by import of such article in unassembled form, by changing the country of its origin, or in any other manner. Now, people may do this, but still, if it is found that these goods are liable to this anti-dumping duty or to this countervailing duty of subsidy, then we will be imposing it. Next, absorption. If there is a decrease in the export price of an article without any commensurate change in the cost of production, then again we call it as an attempt of dumping or an attempt of sending goods cheap. Now, non-applicability. When the above duties will not apply, it will not apply when the articles are imported by either 100% export-oriented undertaking or by SEZ, unless it is specifically made applicable to them, or such article is either cleared as such into DTA or used in the manufacture of any goods that are cleared into DTA. So only in these two cases, SEZs and EOU will have to pay these duties. Otherwise, for them, both countervailing duty and anti-dumping duty is not applicable. Now, in case of circumvention of duty or absorption, what we saw above, duty may be extended, modified from such date, not earlier than the date of initiation of inquiry. Fine. Now coming to a situation where the goods are coming at a lower price to India. Now, the most important point is there could be one of the reasons, either dumping or subsidy. But on the face of it, it is appearing that you know that the foreign government has given subsidy, plus at the same time, the goods are coming to India at a lower price. So you cannot impose both the duties. That is anti-dumping also and countervailing also. You have to impose one of the duties. So what is this particular section 9b saying? Both countervailing and anti-dumping duty cannot be levied for the same reason. So if it is only subsidy, you have to levy only the countervailing duty for subsidized article, not anti-dumping. Both duties not leviable if articles are exempt. Both duties not leviable on imports from WTO member countries or countries with whom government has a most favored nation agreement. And provisional countervailing and anti-dumping duties not to be levied on articles imported from specified countries. So these are the 4 pointers which you have to keep in mind when these duties may not be levied. Now, appeal. Let us say the government has levied the duty and you want to appeal against that. So you have to go to the tribunal, which is the Custom, Central Excise and Service Tax Appellate Tribunal. You have to go there. Time limit is within 90 days of the date of order under appeal. So this is our format. So you find assessable value, how to find out that we study in valuation chapter. On that, You multiply this assessable by rate of duty. Let us say basic custom duty is 20%. So 20% of AV will give you the basic custom duty. Add this, right? Now there will be social welfare surcharge, which is 10% of basic custom duty. So 10% on this amount. Again, add this. Now adding all these three will be your total value for the purpose of computing IGST. Now this IGST will be computed on this final value. So whatever is the rate of IGST multiplied by this, you find your IGST, and adding this IGST will give you the total landed price of your goods. Now, goods and service tax compensation cess. Now we know that under GST, there was a compensation cess. Now, how that compensation cess is applicable in customs? The answer is same. On whatever goods the compensation cess was levied in India, if the same goods are imported, the compensation cess will levied at the time of import as well. Then applicable not only on goods, applicable only on goods which are notified by the government, that is on which cess is applicable. Currently, they are levied on luxury and sin goods like pan masala, tobacco. Now they are limited only to these goods. On remaining goods, the cess has stopped. Next is agriculture, infrastructure and development cess. Now what is this? As the name suggests, for the development of infrastructure cess, for the development of agriculture infrastructure, this special cess is levied on some specific items. So what is this? This is levied again on import of some specific items at the notified rate. What are these specific items? Apples, Kabuli chana, urea, etc. Fine. Let us take up some questions. Yes, I think we will take up a practical question. Just a minute, students. Okay. So what is given over here? Determine the customs duty payable under the Customs Tariff Act 1975, including safeguard of 30% under 8B of the said Act with the following details. There is one more duty, which is safeguard duty. Now, accessible value, the goods is sodium nitrate imported from developing country between this period 26 August to 25th August, both days inclusive, valued rupees 30 lakhs. Share of import of sodium nitrate from developing countries against total import 4%. Now, this is going to be important. So, if you remember, we have seen that the safeguard duty will be levied, but not if it is coming from the developing countries, but that is up to 3%. And then the rates of duties are given basic, integrated, that is IGST, social welfare surcharge. Ignore GST compensation and agriculture infrastructure development cess. Now see the chronology and the method of computation. So we first find out assessable value, which is given in this sum 30 lakh rupees. In valuation sum, we'll have to even compute this. To this, you add the basic custom duty, which is at the rate of 10%, which is given in the question. So it comes to 3 lakhs. Now, how to find out this safeguard duty? Now, safeguard duty is 30% on 30 lakhs. Why? Safeguard duty is imposable in the given case and share of import of sodium nitrate from the developing countries is more than 3%. So as we studied above, up to 3% was allowed. But if you are exceeding 3%, then we will not give you any relaxation. Hence, safeguard duty becomes applicable. So 30 lakhs into 30%, which is the rate given in the question, plus social welfare surcharge, which will be 10% of 3 lakhs, which is the basic custom duty because it is computed only on basic custom duty. Add up all this value. This becomes a total value 40 to 30 for the purpose of computing IGST, which is again given as 12%. It has been clarified by DGFT. Wide guidance note that value for calculation of integrated tax will also include the safeguard duty. Hence, we have covered it. Ninth, determine the total duty payable under Customs Act if Mr. Rao imported rubber from Malaysia at a landed price. Now, landed price, which is excluding the duties, is 25 lakhs. It has been notified by the central government that the share of import of rubber from developing countries against total import in India exceeds 5%. So, government has specified this, notified this. Safeguard duty notified on this product is 30%. IGST is 12%. Base CD is 10%. Ignore agriculture infrastructure development cess. Now see. So landed price 25 lakhs. Basic custom duty 10%. Again, since it is exceeding 3%, it is 5% as we saw. So it is again safeguard duty applicable at the rate of 30%. Add social welfare surcharge, which will be again computed only on this 2.5 lakhs. That is not on the safeguard duty, only on the basic custom duty. Add all these value, add all these four on this total. How much is the total? 25 plus, so it is 35 lakhs 25,000. On 3525 multiplied by 12%, you will get your IGST, and total of this is your total customs duty payable, right? Another question. During 24, customs authorities have noticed that there is an increased quantity of product XYZ being imported into India. Determine whether central government should consider levying safeguard duty. So this is a theoretical question that you can make up from the theory. Okay. Let us proceed to the next chapter. Now, students, this next chapter is very important and also interesting. It deals with classification. Now, what is exactly classification? Now, understand the students, the rate of customs duty, as we studied in the previous chapter, is given in the Customs Tariff Act. Now, Customs Tariff Act is a huge book because it covers 98 chapters. All goods are divided into 98 chapters. Few chapters in that are kept blank intentionally so that any new commodity may be added over there. So different goods are classified or are divided, I'll say, into these 98 chapters. Now there is a chronology in which these chapters are arranged. So starting from the most raw items to the most advanced item, this is how all the chapters range from 1 to 98. Now, in this particular case, whenever you are making a new commodity which is not there in market or some different commodity, then always the question comes, how will I find out that where my product falls, in which chapter, in which heading, which subheading? So for that, the customs have designed interpretation rules which helps you in classifying, that is deciding that under which chapter, which heading, which subheading your goods will fall, so that eventually you can identify what is the HSN of your goods, and on that basis you can eventually find out the rate of customs duty and the exemption. Correct? Now let us understand these interpretation rules in details. Now there are in total 6 rules of interpretation, plus there are some general explanatory notes which are 3. Now let us first deal with the 3 explanatory notes. Now these notes are very important because you have to use or apply these notes whenever you are doing interpretation. Now when you go to the customs tariff act, the goods when they are written one below the other, some goods have single dash, that is some names have single dash, and some names have double dash, some names have triple dash. So first is, when you are reading dash before the name of any commodity, how to interpret it. So for this, what does this explanatory note says? That when there is a single dash, it denotes that this said article or group of articles is sub-classification of the article group of articles covered by the said heading. So there will be heading. Now within heading, when any item is given with a single dash, it means that single dash item is the sub part of the main heading. Now extending this logic, if there is double dash before any item, it means that item is the sub part of that item which is having single dash. So heading, single dash, double dash, triple dash, triple dash. So within heading, like how we write now, uh, for example, I have to explain you these 6 rules. So for me, there will be 6 headings. But within each of these 6 rules, there would be subheadings. Maybe under the subheadings, there would be subheadings. So these 6 rules are the headings. Then the subheadings in these 6 rules will have single dashes. If anything is part of that subheading, subheading will be having double dash. So that is how you interpret the dashes. Then wherever in the rate column you are given percentage. So obviously the interpretation is that the rate of duty is percentage of the value. So you have to multiply it by the value. However, where percentage is not given and it is given as per centimeter, per liter, per kg, it means those duties are specific duties which are to be multiplied to the quantitative factor. But where the rate is given percentage, these are ad valorem duties, that is to be multiplied by the value because they are to be computed on the value. Then for every goods, again students, we have 2 rate columns. One is the standard rate and one is the preferential rate. Now what is the standard rate? Standard means the main rate. Preferential rate is a lower rate. Now with some countries, our government may have signed a special agreement whereby those countries' goods, whenever they come to India, they will enjoy the lower rate, which is the preferential rate. So as you would be knowing, right now, government of India has signed a deal with EU countries. They have signed deal with UK. Maybe in future, they will be signing deal with US. So in such cases, wherever any preferential deal is signed, then for those goods, standard rates will not apply. But for all other goods where no such deal is signed, the goods will be leviable to customs duty at the standard rate. So these are the 3 explanatory notes. Now we come to the rules of interpretation. Now, as we saw above, there are total 6 rules. Now, important to be noted is that rule 1, which is the main rule of classification, what it says. Now, whenever you read any chapter, any heading, obviously it will be given some name, which is called as title. Rule 1 says that you should not give much importance to the title, because titles given to any sections, chapters, headings are only for your reference. You cannot do interpretation only by the headings or the titles given. Student, this is very important because normally we believe that if something is written, let us say goods of uh, leather industry. Now we will assume that since the heading of that chapter is given as goods of leather industry, then everything in leather industry will fall over there. Answer is no, because just for ease of reference, because I may have covered major leather products over there, hence I've given the name to that chapter as goods of leather industry. That does not necessarily mean that everything of leather will fall over there. So what is very important, what rule one says is that you will refer to the headings, the titles, but only for reference, just to get an idea. Then the question is, then how will I come to know whether my leather product is actually falling in that chapter or not? So they are saying read the section notes, chapter notes. So for every chapter, every section, many times every heading, a separate note is given. These notes give you the clear picture as to what is included in that chapter, in that heading, what is not included. So more relevant than the headings are the section notes, chapter notes, and heading notes. So you have to give more importance to the notes rather than the heading. This is what is your first rule of interpretation. Now, as I proceed with this rule, I get the main rule of interpretation, which is in rule 2. Now, rule 2 has part A and B. Both are dealing with a specific situation. What is covered in rule 2A? Now, many times, students, it happens that whenever a manufacturer is manufacturing a product, let us say I'm making a cycle. So I'm a Atlas company making cycles. I may not complete the cycle and may not make the cycle in the ready usable condition, and I may keep the cycle in unfinished or unassembled form. That is, when I am sending this cycle to the final uh, shop or the showroom from where the cycle will be sold, for ease of transportation, I decide not to complete the cycle, not to assemble the cycle. Because the moment I assemble the cycle and make it a usable commodity, transporting that cycle will become difficult because it will occupy more space. Instead, I let the cycle be in its unassembled form. That is the tire, the chassis, the handle, and all the accessories, all are separate. And then I pack it and send it in unassembled form. Similarly, it may happen that, let us say I'm selling cars. I have purposely not painted the cars. That is, I have not finished the cars. I have not done the painting. Why? Because I know that during this transportation and handling, there is a possibility that there can be some slight dent or damage. So what I do is, after the cars are sent to the showroom, at the showroom, I hire someone to do the final denting painting. So it may happen that for practical considerations, the manufacturers may not complete the goods, may not finish the goods, and the goods are sent in unassembled, unfinished, or incomplete form. Now, what is the point? Now, if you look at the item which is loaded in the truck from the Atlas company, you will not find cycle. You'll find maybe in one truck only tires are kept, in another truck only chassis are kept, in another truck only the handles are kept. So nobody will say that what you are selling is cycle. The question is how to classify it. Should I classify it as cycle, or should I levy tax by saying that, okay, this truck is only taking the tires, so I will tax the tires by the rate of tires. This truck is taking the chassis, so I will tax the chassis by the rate of chassis. So whether you will apply the rate of cycle or you'll apply the rate of chassis. Similarly, my second example, where car is sent but it is not painted. So technically it is not a saleable product. It is not finished. because still painting is left, maybe fitting of tires is left. Again, how will I tax this car? What will be the rate applicable to this car? So for this, Rule 2A has been made. What does Rule 2A says? That whenever you are reading the heading of any chapter or any uh, commodity, obviously it will be covering the finished goods. So no heading is given in the customs tariff act saying unfinished car or car in the unassembled form. No, it is always covering the entire final product. Now, what this rule 2A says that even though the heading is referring to finished goods or completed goods, you will also include in that heading goods which are in incomplete form, unfinished form, unassembled form, and possessing the entire essential characteristics of the finished goods. It means the car without painting is also a car only. It is having all the essential characteristics, only the final finishing is pending. Similarly, a cycle which is even though not assembled, when it will reach the cycle go down or the shop where from where it has to be sold, the shopkeeper will require only half an hour to assemble it. So that will not change the nature of the commodity which I am sending. So what is the rule? That even the goods which are sent in unassembled form or which are sent in unfinished form will be taxed as final goods only, provided they have the essential characteristics of the final goods. So this is what is a very important interpretation rule. It is applicable because practically many industries are not finishing their product. They are keeping it in some unassembled stage or unfinished stage and sending it in that form. So they will also be taxed as finished goods only and not as parts. This is what is coming out from the application of Rule 2A. I hope this is clear to everyone. Then comes the second part, 2B. Now, what is 2B dealing with? Now, many times when you read the heading may not cover the name of the final product. Like as I said, I gave you an example, what it said, products of leather industry. So similarly, you have headings which will say, let us say, products made of mangoes. Another heading may be goods made of milk or milk products. Now, in such cases, many times the headings are such that they make reference to the material or substance, like food product, milk products, or products made of mango. Now, in such cases where the name of the actual final product is not given, but the name of the materials or substances is given, then how do you classify your final product? So the answer given is reference to material or substance would also include reference to the mixtures combinations made out of that material. So what does rule 2B part 1 says? That whenever the headings of any chapter or of any section are covering or referring to the materials and substances, so whatever is your final product made out of that material, that will be covered in that heading only. It means that the chapters giving references to the names of the raw materials, like as I said, milk products. Now milk is a raw material. Now there are multiple products made out of milk. All will fall in this chapter only. Again, subject to that the section notes or chapter notes are not giving any specific exclusion. So general rule 2B is that whenever the headings are giving references to materials, components, substances, then whatever is your final product made out of that raw material, that substance will be covered in that heading only. The second part of this rule says reference to a material substance would include reference to goods consisting wholly, partly of such material or substance. So whenever you are again classifying your goods, now maybe your goods may not be only having that one material. Obviously, many times whatever we see there, it is made up of multiple things. But where it will be classified in that chapter which is having its material. Now, even that material may be partly or wholly in your product, that makes no difference. Like when I just gave you example of mango products and I gave you example of milk products. So in this case, let us say what you have made is mango pickle. Mango pickle, the major component is mango, but plus there are other components like you use different types of salts and spices. So partly is mango, or you can say, sorry, wholly is mango, and then minorly it is other products. Mango pickle will be classified here. Similarly, in milk product, everything like curd, everything like all types of milk sweets, everything like Shrikhand, everything will be classified over there because again, it is uh, made up of wholly of milk. Now, interesting point over here is it is also saying wholly or partly made up of such material. Now, here there will be a problem. Let us say what I am making is mango lassi. Now, mango lassi has both items and both are significant because a person who is coming to buy mango lassi will require proper mango also so that he gets the proper taste and flavor of mango. Plus, the base will be lassi. Now, in this case, this particular rule creates a problem because this rule says that your product will be classified in that heading which is referring to the substance. Now, it may be consisting wholly of the substance or partly of the substance. Now, in this case of mango lassi, my product is consisting partly of mango and partly of milk, which is a milk product, that is the C. Now, in this case, rule 2b will create a problem for me because if I am applying rule 2b plainly, my product, that is mango lassi, is equally classifiable under the chapter of milk products. And it is also classifiable under the chapter of mango products. But this is what is the answer we get from 2b. Now, how to handle it? For that, you have rule 3. So when does rule 3 applies? It applies in the cases where your goods get classifiable under two or more headings because of rule 2b. Now, when it is getting classified under two or more headings, now out of that, which heading to be used? That is decided by 3, and 3 gives you 3 rules A, B, C. What is rule A? Rule A says out of the different headings that you are having, classify your goods in that heading which is more specific than the heading which is more general. Now, let us say there is some heading which is specifically saying curd or lassi, then I will classify mango lassi in that rather than in the heading which is only saying milk products. Because milk products is more generic, whereas curd or lassi is more specific. So first rule which 3A gives is heading providing a more specific description should be preferred over heading providing a general description. I hope this is clear to you all. So you will classify your product by applying rule 3A, and rule 3A will apply when out of the multiple headings that you are having, one of the heading is specific. Now, what if all the headings are general? There is no specific heading. Then 3A will not help. Then you come to 3B. What is 3B saying? It is saying you classify the goods in that heading which gives the essential character to your goods. So maybe all headings are general, like as I guess, give the original example, one is milk product, one is mango product, both are general, and there is no heading covering milk or curd specially. Sorry, curd or lassi specially. So I cannot apply 3A because there is no specific heading. Whatever headings I have are generic. Now in such cases, they say apply this test, which is the essential character test. That is, you classify your goods in that chapter, in that heading, which determines or which reflects the real character of your goods. So, because of this particular rule, your product will get classified into that one heading which is reflecting or representing the true nature of your product. Now, how to determine the nature or character of your product? So for this, you should see the usability of your product. You should see the functionality of your product. You should see the qualities, the scientific and technical specifications of your product. And then using these features, you will determine which heading is giving the true character or true nature of your product, and you will classify your product over there. Now, practically, majority of the classification gets covered either in 3A or in 3B, because many times you will find headings which are very specifically covering your goods. Problem is solved. So 3A will help you get the classification. If 3A does not help because all the headings which you are having are generic, then 3B will definitely help, because out of all the headings, one heading will be such that which is actually reflecting the true nature of your product. But at times it may happen that even 3B fails, because you are not getting one single heading even by going by the character test. Then you have no option but to apply the residuary rule which is given in 3C, and 3C simply says latter the better. So what is 3C basically dealing with? So as per 3C, what you will do is you will classify your goods in that heading which sequentially comes later. So let us say out of the 2, 3 headings which I am having, one is in chapter 18, one is in chapter 21, and one is in chapter 40, 40. Now in this particular case, if 3A, 3B is not helping me, both are not giving me my answer, then I will apply 3C. And out of these 3 headings which I am having, which all seems to be equally correct, then I will see sequentially which heading is the latest. So in my example, it is chapter number 4040. So I will classify my goods in chapter 40. So numerically, whichever heading is the latest, last, sequentially at the end, I will classify my goods in that heading. This is what 3C says. Then you come to rule 4. Now, students, rule 4 is required whenever something of a very different nature, character is to be classified, and you don't have goods which are matching with your goods. So let us say when for the first time mobile phone was invented, definitely your uh, this classification never had any such name like mobile handset, mobile phone. Today we have even more so many gadgets and so many technological things coming up. Now, how to classify such new goods for which there are no names existing either specifically or even generically, because they are totally new? Then rule 4 comes into picture. It says that where you cannot classify the goods as per the above rules of 2 and 3, you classify your goods under the heading which is similar to your goods. Akin means similar. So let us say I'm not having anything called as mobile handset. Then I will try to find out what is my mobile doing. It is used for calling, or it is used for communication. Not even calling, let us say communication. So I will try to find out that heading which is about communication equipments, and then I will classify my mobile in that heading for the time being till the schedules are amended and there is a specific entry for mobile. So rule 4 helps us in classifying your goods in this manner. Now, with rule 4, we complete the classification rules for your goods. Then in rule 5, we come to classification rules for the boxes, the packages. So you have manufactured a mobile handset, but when you want to send it to the market, you will pack it in some box. Firstly, the outer box of the mobile phone, and then one carton in which that will be kept and it will be sent to the market. Similarly, let us say you are manufacturing chocolates. So you will pack it in a box. That box will be placed in a carton and then it will be sent to the market. Now we are talking about classification of these cartons and boxes, because again there are some industries, some businesses which are only making these cartons and boxes. So for them the final product is the carton and boxes. Now for them, what will be the classification rate? So here rule 5 applies. You don't have to go to the earlier rules because you are specifically talking about packing items. Now in this case 5A says that check whether your goods, sorry, not goods, your packing material is such that it is designed in such a manner that it can be used only for that one particular product, like or camera, the camera case, or musical instrument case like the guitar case or the pistol case. All these are so designed that they are suitable only for holding or packing that particular commodity, nothing else. In this case, where they are made so specific that they can be used only for packing or holding a particular product. Interestingly, Rule 5A says you classify your packing material in the heading of the goods for which they are designed. So interestingly, your packing material is, let us say, made of hardboard, but it will be classified in the musical instrument chapter. It will be classified in the camera chapter. It will be classified in the pistol or gun chapter. So specific containers, specific packages are to be classified with the respective article for which they are so designed. Exception where packing material itself gives the essential character as a whole. So if packing material itself is having its own characteristics, then fine, you can classify it independently. Then comes the next 5B rule, classification of packing material and packing containers. So packing material and packing containers presented with the goods therein to be classified with the goods if they are of a kind normally used for packing such goods. So same rule what we saw in previous 5B. Here again exception is durable containers and containers which are capable of repetitive use. Again, they have to be classified independently. So if I have to summarize this entire rule 5, rule 1 in 5 is if your packing material, packing box is so designed that it can be used only for one product, nothing else, then your packing material will be classified in the chapter of the product. But if your packing material has itself its own characteristics identity, which you can say that it can be used for other goods also, like hardboard boxes, they can be used for multiple items, then they will be classified in their own chapter. Like if it is made of hardboard, you will go to the chapter of hardboard. If it is made of wooden material, you go to the chapter of wooden material, and over there it will be classified. It will be not classified under the heading of your goods. Then second is if your packing materials are durable, capable of repetitive use, like gas cylinders. Now, gas cylinders will be used multiple times, or your cold drink bottles. You consume the cold drink and you return back the bottle at the hotel. In such cases, they are again to be classified separately and not with the goods. This is what is rule 5. Now, what does rule 6 deals with? Rule 6 says that you have applied rule 1 to 5 for deciding the main chapter heading. Now, once you have decided the main chapter heading, within the chapter heading, you will have multiple subheadings, subheadings. Now, apply the above rules again for identifying the subheadings and the subheadings. So, the manner in which you first decided where my products are falling under which chapter, which heading, on similar lines, once you've decided the heading, the subheadings of that will be decided on similar lines. Subheadings of that will be decided on similar lines. That is what is rule 6. Then comes the next rule for project imports. Now, what are project imports? So many times you are importing not one item but a multiple range of items, but they are imported for one specific purpose, a project. So let us say you are setting up a hydropower plant in India. Or another example, let us say we are making the bullet train in India. Now, this bullet train is a project. Now, there would be n number of thousand small and big parts required to complete the train, the bullet train especially. Now, whatever imports I am doing, they will be happening at different point of time. Let us say it takes a 5-year period to make a whole bullet train, for example. Now, for that, I will require different parts, all specifically for the bullet train. Now, I'll be importing these items at different point of time in this 5 years period, and at different times I will be importing different items. Now, individually, independently, these items definitely will have a different chapter applicable to them, and hence a different rate and a different classification. However, the rule given is that if I notify to the customs that, see, this is the project, and I give them the list at the start that these are the various items which I'm going to import for this specific project, then they say all items imported under a project, irrespective of their nature, etc., will have one consolidated rate of custom duty. So, when you are importing something for a very specific project, like setting up a nuclear plant for generating electricity, like I'm sure you all would be knowing that we have set up that plant and further setting up more plants in aid with Russia. So Russia is providing us that entire technology, and with their technology, we are setting up the plant. So in this particular case, this rule is applicable. So whatever are the multiple small and big parts I'll be importing, I will not classify them in their respective chapters, not apply separate rates. All will be applied a single consolidated rate. Further, individual exemption notification is applicable even for items grouped under project imports. So that is a favorable thing, that even though I am applying a single consolidated rate, but if any of my items are eligible for exemption, I will take exemption for that individual item and I will not apply the consolidated rate. Correct? So here some specific questions are asked, students. If you see the questions, you'll find that all the questions are very specific. They are very much linked to one of the points that we have studied. For example, they are very specifically asking, explain the provision of Rule 2A. So we saw what is Rule 2A dealing with. That is where goods are imported, but they are not in the finished form. They are in the unassembled or unfinished form. So Rule 2A says, if they are having the characteristics of the finished goods, we will classify it under the chapter of finished goods and not under the chapter of individual parts. Then second question is, what is the purpose of including general rules of interpretation of first schedule? Do they form part of tariff schedule? Explain ICAI rule of interpretation. So first is, what is the purpose of the general rules? So the purpose is that the entire customs tariff is very vast. It covers lakhs of goods having 98 chapters and multiple sections. So it may be difficult to find out exactly where your goods are falling. So you need some assistance, you need some guidance. So for providing the guidance, this general rules of interpretations are made. Second, do they form part of the tariff schedule? So answer is yes. So the tariff schedule itself has given you the rules. Then what is the Akin rule of interpretation? So that we saw, Rule 4 is the Akin rule, which says that when you cannot classify your goods as per Rule 2AB or 3ABC, generally this will happen in case of a very new type of product for which till now no classification has been made. So for such products, such goods, you have to follow the again rule. Then write a note on project imports we just discussed. Explain rule 3. As I told you students, 3 is the most important rule. It has three parts A, B, C. Firstly, when rule 3 is applicable, when as per rule 2b, your goods can be classified in multiple headings, multiple chapters, then how to decide exactly which heading or chapter will be applicable? So for that, rule 3 is applicable. Firstly, 3a says go by that chapter which is specific over the chapter which is general. Then rule 3b says if that doesn't work, 3a doesn't work, then find out the character and classify your goods in that chapter which represents its essential character. And then rule 3 says if that also fails, then go by the latter the better rule. Question 5, explain the meaning of the abbreviation percentage. So we have studied this in our interpretative notes that whenever percentage will be put in the rate of duty column, it will mean that the goods are leviable to ad valorem rate, that is the rate which will be applied on the value of the goods. Fine. So with this, we complete this chapter also. Now we'll take a break, and after the break, we'll go to the next very important chapter, that is valuation. So we take a break. Let us go to the valuations chapter now. Now, students, when we talk about valuation, first important thing is when will this chapter apply? This chapter will apply whenever the rate of duty is given as a percentage. So as we saw in the previous chapter, whenever it is given as a percentage, we will treat it as percentage of value. That is, we will treat it as an ad valorem duty. Now, whenever the duty is a percentage of value, that is, it is ad valorem duty, then you will refer to this chapter, which is of valuation. Now, what will be the value of goods? So the answer is given in the definition in section 2 clause 41 of the Customs Act. So Customs Act says the value will be the value as determined by section 14.1, which is the transaction value, or the value as determined by 14.2, which is the value fixed by the government, which is called as the tariff value. Now, before we go to these valuation provisions in detail, we need to understand some technical terms relating to valuation, and these terms are commonly used terms in import export, that is international trade. So first is the X factory price. So let us say I'm purchasing a particular type of machinery from a person in Germany. Now, the place where the person in Germany is manufacturing the machine, his factory in Germany, the price at his factory gate is the X factory price. Then the second is FOB price. This is the price at which the German person is bringing the goods to his German port, and the goods are loaded on the ship or the aircraft. So it is the price of the goods up to the foreign country port or airport. That is the free on board price. And then comes a CIF price, which is the price of these goods when they reach India. So the price of the goods at our Indian port is CIF. So full form of CIF is cost, insurance, freight. So it covers the total cost of the goods plus the insurance and the freight required for bringing the goods up to the Indian port or airport. Now, what is the rule? The default valuation is the transaction value plus certain cost components, which the rule has made it specifically compulsory to be added. This is the default mode of valuation. However, as we saw, there are two methods. One is the default or the transaction value method, and that second is tariff value method. Now, the tariff value supersedes the transaction value. So, in case where the government, that is the CBIC, has notified values for any class of goods, then the values will be considered as the assessable value, and your import duty will be calculated with respect to this tariff value. So your import duty will be calculated by multiplying the rate of duty to this value. Most important, this section 14.2 is overriding 14.1. Hence, the 14.2 valuation will have precedence. So you'll first check if any tariff values have been fixed by the government or the CBIC. If they have been fixed, you will not go to 14.1. You will not apply whatever we are going to study hereafter. Now, if tariff values are not fixed, then you will apply 14.1. What does 14.1 says? As per 14.1, the price of your goods is the transaction value, which is nothing but the price actually paid or payable for the goods. So transaction value, as the name suggests, is the price, is the value at which the transaction takes place. Most important, we want the value for the price at which the goods are sold for export to India. So in this example which I had taken, so when we are taking the transaction value, we will take the price which my German supplier has charged me while sending the goods to India. So this is the price at which the goods are sent or sold by the German supplier to me. That is what is the transaction value. Second, for delivery at the time and place of importation, which means what? We want the CIF value. That is a value which is the price of my goods till my Indian port. Now, for accepting this value as the final value, this section has put in two broad conditions. Now, again, you'll find this similar to what is our GST valuation in section 15 of the CGST Act. Same conditions are here. First, buyer and seller are not related. And second, price is the sole consideration for this transaction. Now, when both these conditions are satisfied, one, buyer and seller are not related. What it means, we'll see the definition of related. Two, whatever price the seller has charged, the buyer is going to pay only that price and nothing separately to the seller. So the price charged by the buyer, sorry, by the seller and paid by the buyer is the complete value of these goods. There is no additional consideration in any form flowing from the buyer to the supplier. That is what is said to be price is the sole consideration. Then further, some additional obligations of importer where the board has reasons to believe that the value of goods may not be declared truthfully. So now, as a procedural compliance, some additional conditions, obligations have been cast on the importer, which the importer has to satisfy. And only on satisfaction of those conditions, finally your value will be accepted. Now, whenever we'll be taking the value, a very common question will come that majority of these values amounts would be in foreign currency, but we need to compute the duty in Indian currency. So we will require a rate of exchange. What will be the rate of exchange? Because we all know rate of exchange is also fluctuating. So they are saying you will take the rate of exchange in case of imported goods of the date of filing of the first bill of entry. In case of export goods, the date of filing of the shipping bill or the bill of export. So which dates rate of exchange is to be taken is pretty straightforward. Now the second follow-up question that may come is that rate of exchange given by whom? Because on this particular date, whatever we have just seen, on that date there are multiple exchange rates for the same currency, like one exchange rate given by a bank, one exchange rate given by the money changer, authorized money changer, one exchange rate which may be prevailing in the market. Out of this, which rate is to be taken? The answer is the rate which is notified by the CBIC. So, for the purpose of conversion of currency, you will take out of all these rates the rate which the CBIC will give you. So, either CBIC will provide its own rate, or the CBIC will tell you that, okay, you take this particular rate of RBI, example. So, you will take that rate. Now, when you read the custom provisions which are contained in section 14 of the Customs Act makes a specific reference to custom valuation rules and requires you to compulsorily go to the rule. Now, this is where GST valuation and custom valuation differs. In GST, the valuation rules have to be checked only when your transaction value cannot be adopted because one of the conditions for adopting transaction value are not satisfied by you. But that is not the case with customs. In customs, irrespective of whether the conditions are satisfied or not, in both cases, you have to compulsorily come to the valuation rule. In fact, it is like this. If the conditions for accepting transaction value are not satisfied by you, like price is not the sole consideration or buyer seller are related, you may start with rule 4 directly. But where the conditions of transaction value are met, you will start with rule 3. So in any case, you have to come to the valuation rule, and most important condition given over here is these rules have to be applied sequentially. Now, Since different terms will be used in these rules, we need to first make ourselves clear with these terms. So first, we go to the definitions given in the rule. First definition is of place of importation. In simple words, it is the place where the goods are landing. So if my machinery, which I'm importing from Germany, is landing at the Bombay port, the Bombay port becomes the place of importation. Second, we saw that buyer and seller should not be related, otherwise your transaction value may be rejected. Now, who is a related person? So that is defined. It says that person includes legal person and they will be deemed to be related if they are directors of one another business. So it means the company and its director. They are legally recognized partners. So firm and the partners. Then persons are employer employee. So first three are clear: director company, partners firms, and employer and employee. Then comes where a third person is controlling these two persons. So these two persons will be related when they have a common person who is controlling them or who owns or holds 5% or more of their voting shares. So when a third person owns more than 5% in both the companies will become related. Then one of them controls the other. Third person controls both of them. Such persons together control a third person. So all these are control relationships. Then they are members of the same family. So members of same family is again defined to mean spouse, children, brother, sister, parents who are dependent. Or last is one of them is the sole agent, sole distributor, sole concessionaire of the other. So in all these cases, we will treat both the buyer and seller as related. Now you come to each of the rules. So the first rule is rule 3. What it deals with? It says that the value of your imported goods as per 3.1 will be your transaction value. That is the price at which you have entered into the transaction. Most important point is that this value has to be adjusted for the cost for the different reimbursements given in Rule 10. It means certain amount of reimbursement or cost have to be compulsorily added in your transaction value to ultimately arrive at the assessable value. Further, your transaction value is subjected to Rule 12. Now, what is Rule 12? Rule 12 gives the officer a right to reject your goods if they have a doubt about truth or accuracy of the data of the information which you have shared with them. So wherever any data which is shared by you is found to be doubtful, or whatever figure you are giving to them, they doubt the truth or accuracy of your figures, Rule 12 empowers them to reject your value. Now, why Rule 3 is subject to Rule 12? Because in 3, we are asked to take your transaction value as the assessable value. But if using the power of Rule 12, if the officer rejects your value, then anyways the entire Rule 3 is gone. You will have to jump to Rule 4 onwards. Now, there are some conditions given in this Rule 3. So you study two conditions in the section 14, that is buyer seller not related and price is the sole consideration. Besides that, some more conditions are given in this Rule 3. You have to comply with all these conditions. Then only your transaction value will be finally acceptable. First, what is the first condition? There should be no restriction put on the buyer as to how the buyer will be using these goods or handling these goods or disposing these goods. Means the seller should not restrict the buyer on its further use. However, this point has an exception where any restrictions are required by law. For example, you are selling to this buyer something which is having a restrictive use, which is requiring food license, drug license. In that particular case, obviously, the restriction which you will put will obviously have these restrictions saying that you cannot further sell it, or you cannot give it to others because it is a restrictive item. So these restrictions which are required by law can be put by you, but no restrictions other than the restrictions required by law can be put by you. If you have put any such condition or restriction on the buyer, then your transaction value is not acceptable. Next, another condition is that the sale or the price which you are quoting to the buyer should not have any such consideration or condition for which the value cannot be determined. So, for example, you are selling goods to the buyer and saying that in return you will have to take care of my parents for the lifetime. Now, this condition which you have put or the consideration which you are demanding is in such a form that it can never be valued. Now, if it cannot be valued, how will you determine the money amount and how will you tax it? So the obvious condition is that whatever condition consideration you are keeping, it should be valuable. Next, there should be no further consideration being accruing to the seller. It means you should not put such a condition that today the buyer will pay $100 and also in future the buyer will pay some amount. So firstly, you should try not to keep any future consideration. Point number one. Point number two, even if you keep it, then it should be such that it should be capable of being considered in Rule 10. So when we'll read Rule 10, which provides for some additional cost and expenses, whatever consideration you are fixing or whatever additional consideration, future consideration you are promising to give to the seller, the consideration should be such that Rule 10 can find out its value today. Then next condition, which is a repetition, is buyer seller is not related. But interestingly, the same Rule 3 carves out saying that even if buyer and seller are related, your transaction value will be accepted if first, you establish that your relationship has not affected the price. So how you'll establish? You will prove that, see, whatever price I'm levying to my related buyer, I'm also charging the same price to non-related buyers. This is proving that relationship has not influenced the price. Second, you have to also prove that the price which is charged is very close to the other values which Rule 4, 5, and 6 and 7 are saying. So even if you reject my value, you will take value as per 4, 5, 6. And anyways, my value is very closely matching these values. So if my value is closely matching these values, then better do not reject my value. So when the importer proves these things to the custom officer, they will accept the importer's value. They will accept the transaction value even if the buyer and seller are related. Now, if your transaction value is rejected for one of the conditions or one of the reasons above, in such cases, now you imported material X, value of your import is rejected, but we need to find out the value of this material X. So what we will do, Rule 4 says, find out if anybody else is also importing the same material. Identical goods means same goods. So you have imported material X. Is anybody else importing material X? So you have to find the value of that other import. So find out the transaction value of same goods imported by someone else. Most important is that other import should be at or about the same time when you have imported. So let us say I am importing today, which is 1st of August. So other import is on 1st of August only or nearby date. It should be at the same commercial level and substantially the same quantity level. So I have imported as a wholesaler. Obviously, the other import should be also as a wholesaler. If it is done by a retailer, you cannot take that price. That is same commercial level. Second, I have imported in 1 lakh quantity. That person has imported in only 1,000 quantity. Again, we know that because of quantity difference, the price may change. Hence, the quantity should also be same. Now they have relaxed this condition here itself, saying that if there is import which you are finding of the same goods, but at a different commercial level or a different quantity level, you take their price and do adjustment for this difference. So take that price and adjust it for the difference of wholesaler retailer. Take that price, adjust it for the difference of 1,000 units and 1 lakh unit. Next, In case that other import is at some other port, so the distance between your port and their port is different, so that has to be adjusted. Second, even if it is imported at the same port, but you are importing by air, that person is importing by sea. So again, the difference of this import has to be adjusted. So wherever there is difference in the medium of import and the place of import, that difference has to be adjusted. And finally, in case you find multiple imports of the same goods, take the lowest value out of all of them. Then comes rule 5. Now, rule 5 says that you imported X, but nobody else is importing X, so rule 4 fails. Try to find if anybody is importing Y. Now, what is Y? Y is that commodity which is, though not same to same, but it is parallel to X. So let us say I'm importing Natraj pencil and you are importing Camlin pencil. Both are ultimately pencil, having same characteristics, same functionality, same use, and also they are commercially interchangeable. Commercially interchangeable means when you go to a shop and if the buyer is asking for Natraj, but if Natraj is not available, the buyer is ready to buy Camlin. So it is said to be commercially interchangeable, right? So such goods are called as similar goods. Now, if you find a sale of a similar goods, not your same goods, but similar goods, no problem. You can take their price and we will make slight adjustments. Again, all the conditions and adjustment we studied above in rule 4, that is for identical goods, apply over here as well. Then come rule 6, which says that rule 3, 4, 5, if all have failed, now by default you have 7 and 8. Now our rule was that you flow sequentially. But rule 6 says that the application of 7 and 8 you can interchange. That is, instead of first going to 7, you can go to 8. That is your choice. And at your request, with the approval of officer, this order can be changed. Now, what is rule 7 saying? Now, rule 7 says, let us say you are not finding identical goods, similar goods, because nobody else is importing the same or similar goods. Then what you will do? The law says, no worries, do one thing, see what you will do of your imported goods. So my price at the time of import was rejected for some reason. They are saying, no problem. What do you do of these goods after import? So after import, I sell them in India. Now, if I'm selling these goods after import in India, they are saying, no problem. Let us do one thing. Let us take price of your goods at which you are selling it in India to an unrelated person. Take that price. So our starting point is the price at which these goods are sold in India to unrelated person. Now, what is this greatest aggregate quantity? So if I'm selling in different quantities, you will take the price at which I'm selling the highest quantity. Now take that price. But remember one thing, this is the price post import and this is the price which is the domestic price at which goods are sold in India. I cannot take the price as it is. I will have to subtract from that what? Everything that has been added to these goods post importation. Now, what all things I would have added? First is I would have added custom duties. Second, I would have added the transportation, insurance, and other cost after its import in India. So for domestic transportation, whatever is the cost. And also I would have added my commission, profit margin, and my general common expenses share. So my final sale price in India, you'll come backward by deducting all these amounts. So what is left will be your assessable value. Then other than this, the second option is rule 8. Rule 8 is the computed value. I always call this as the costing value. So the value that you will derive by doing costing. Now for this, you need to get your supplier's details of cost. So for applying this rule, you will have to find out the cost of raw material and other fabrication, the cost of labor, processing, all things that your supplier may have done to produce these goods in his country. So in short, you are doing costing, find out the manufacturing cost, then to add the profit and margin for covering your general expense. And for this, you will have to take the industry rate. How much the industry who is manufacturing same kind of goods in that same country is adding towards profit and common expenses. This will give you the final price of the product. To that, add all the expenses which we are going to study in in rule 10. This total will be the computed value. So this is how you will find out the value using all these values. So first is your own value, rule 3. Second, value of your same to same goods imported by somebody else at or about the same time in the same quantity at same commercial level. That is rule 4. Second, rule 5 is where you will take the price of not same to same goods, but similar goods, similar to your goods, but slightly different. All this fails, then rule 6 says you can apply 7 and 8 in reverse. Now, what is 7? Deductive value. After import, if you have sold the goods in India, take that price and come backward by deducting everything that you have added in the value after its import. So come backward. That is deductive value. And rule 8 is computed value. Computed value is you get the costing details of these goods from your supplier and then do the costing of these goods and find out its computed value. Now, how to apply these rules? The valuation rules have to be applied sequentially. This is a rule. However, importer may request for proper officer to apply computed value before deductive. This we saw. So 7 and 8 only can be interchanged. And then the residuary method can be considered if valuation is not possible by any of these methods. So if all of the above method fail, you have no choice but to come to rule 9, which is the residuary method. Now, importantly, student, in rule 9, the law has not provided any method. It is only telling you what you can do in such cases. So they are saying in such cases, do one thing, determine the value using some reasonable means. What is the reasonable means? You have to find out the value, applying the valuation section, applying the valuation rules by making slight modification wherever required. So what you are supposed to do here is rule 9 requires that you have to now use some judgment. But while using the judgment, you have to apply whatever is given in the entire valuation section and rules. So try to derive a judgmental value, but that judgmental value should be by applying the principles and provisions of the rules. Now, while applying this judgmental valuation rule or residuary valuation rule, what you cannot do? You cannot take the selling price of the goods which are produced in India. Second, the system which provides for acceptance of higher of the two values, price of goods in the domestic market of the country of exportation, then cost of production other than computed value, price of goods for export to country other than India, minimum custom values, arbitrary values. So these you cannot take, right? Now we come to rule 10. What is rule 10 dealing with? Rule 10 is dealing with what are the expenses that have to be compulsorily added while doing the valuation. So rule 10 is compulsory with all the above rules. So whatever value you are finding out in 3, 4, 5 or 7, 8, rather not 7, 8, you have to add certain expenses to that. Now, what expenses are to be added? That is what is given in rule 10. Now, rule 10 sub rule 1 says that check if all or any of these expenses are there, and if they are not already included in the price in the transaction value, you'll have to add it. First, you have to add commission, except the buying commission. Second, you have to add the cost of container, packing material, everything. Third, where the engineering work, design work is done outside India, not in India, then the value of that engineering work, design work has to be added. Plus, if any raw material, tools, dies, consumables which you require in the production of these goods are supplied to you free of charge by the buyer. So the value of that material tools die has to be added. Royalty, license fees, which is a requirement of your product, has to be added. If any subsequent sale proceeds are to go to the seller, that has to be added upfront. And all other payments, which are part and parcel of this sale. So if you have put any additional payment requirement, which is directly related to this sale, it has to be added. Now, besides this, what is very important is 10.2. So about 10.1 is very specific. Those things will come only if those things are present. But 10.2 will come in all cases. What does 10.2 says? Now, if you recall section 14, it said that we require the value at the time and place of importation, for which I said you have to take the CIF value. Now, how will you arrive at the CIF value? For this rule 10 bracket 2 says, add the transport cost, add the loading, unloading cost, the handling cost up to the place of importation. That is the place where your goods will reach India, that port from where you will be clearing the goods. Second, also add the transit insurance. So these are the two costs which 10 bracket 2 has made compulsorily to be added. Now, in this, if you are having actual cost of transport and insurance, fine. But what if you do not have the actual cost of transport? So students will have to learn this in mind that if in the exam, the actual freight is not given in the question, still you have to add it. How? You take 20% of the FOB value. So whatever is your custom FOB, of that amount, take 20%, that will be deemed to be your freight cost. Similarly, if custom FOB not ascertainable, but you are given the custom FOB plus insurance. So if breakup of custom FOB is not given, but you know the custom FOB including insurance, no problem. Take 20% of the custom FOB plus insurance because we have no choice. Second, for insurance cost, if actually is given, fine. If actually is not given in the sum, student, please remember you have to do this by yourself. You have to take 1.125% of your customs FOB as the deemed insurance. Again, if custom FOB is not given in the sum, but custom FOB plus freight is given, you have no choice but to take 1.125% of custom FOB plus freight. Very important, where your goods are coming by air. So in question, air freight is given. If it is given, now the rule was if actual is given, you take the actual freight. But if the freight is air freight, then you have to ensure that it will not exceed 20% of FOB. It means your actual freight given in the question, compare it with 20% of FOB, whichever is lower, that freight you will add. Next, in case goods imported by sea or air and then transshipped to another custom station in India. So let us say goods are getting unloaded at the Bombay port and from there they are sent to the Chennai port, which is called as transship. Then the cost of insurance, transport, loading, unloading, handling associated with such transshipment are to be excluded. So your transport cost will not include freight from port to the ICD, CFS, that is Inland Container Depot or Container Freight Station. So in short, your first port of importation is the place of importation. You have to take all the expenses only up to that, not further. Next, this cost of import transport will include ship demurrage or charges for the chartered vessels or letterage or bar charges. So if these are given in the question, students, kindly make a note. You have to add it in the value. Now, how to find out custom FOB? Because over there we saw if the actual freight or actual insurance is not given, you take 20% or 1.125% of custom FOB. So the question is, what is custom FOB? So it is the FOB price fixed by the seller plus all costs given in 10.1 above. So when you add up all this, the value that you get is the custom FOB. How to find out final assessable value? This custom FOB, which includes 10.1 cost plus the 10.2 cost, which is for freight and insurance. This gives you the CIF value, that is the final assessable value. So students, this is how valuation is to be done. So you have to apply rule 3 to 10, in which 10 is the compulsory rule. 11 irrespective of which valuation rule you are adopting, whether 3, whether 4, whether 5 or 8, you have to ensure that you will compulsorily include the cost which are given in Rule 10. In Rule 10.1, some specific costs are given. If those costs are available in the question, exam question, you will include them. But 10.2, whether given or not, you have to compulsorily include them. So students, kindly make a note of this difference between 10.1 and 10.2 cost. Now coming to Rule 11. What is Rule 11 dealing with? It deals with declaration by the importer. Now what it says, that the importer or his agent is required to give a declaration that whatever details, whatever values, whatever documents the importer has provided are true and fair. That is, all the documents, all the details given are correct and accurate. Now, this is the Rule 12 which we were discussing above. So Rule 12 empowers the officer to reject your value. So despite of you claiming up the truth and fairness, Rule 12 empowers the officer to reject your value completely. So power of proper officer to reject value of imported goods declared by the importer, even if he has reason to doubt the truth or accuracy about the such value, and it shall be deemed that the transaction value of such goods cannot be determined. So this is a very, you can say, powerful tool given in the hands of the custom officer, that wherever they have any doubts about your value, they can straight away reject your value. Now, all this was custom valuation rule in case of import. Now we go to custom valuation in case of export. Interestingly, students, custom valuation of export is very similar to custom valuation of import. Let us first go to the definitions. First is the definition of goods of like kind and quality. What is the meaning of goods of like kind and quality? It means what goods you are exporting. If there are any other export goods which are exported by someone else, but they are completely identical, that is copy paste, same goods what you are exporting, they're exporting, or if they are not completely identical, but still they possess such physical characteristics, they are of such a quality and have such a reputation, that is brand, so that they are capable of being replaced by your goods. So either your goods or even in their place, these goods can be doable. Then they are called as goods of like kind and quality. Further, these goods are capable of performing the same functions what your goods can perform, and hence they are commercially interchangeable. So what is commercially interchangeable? So commercially interchangeable is, instead of my goods, the buyers in the market are ready to accept these goods also, then these goods are called as commercially interchangeable. Now comes the first valuation rule for export goods. What does the first valuation rule says? Again, similar to the import rules, the export valuation rules also say the same thing. What will be your value of export? It will be the transaction value. Over there, in case of import, it was subject to Rule 12, that is the right of rejection by the proper officer. Here it is Rule 8. So you can say the first part is similar. Now, what are the conditions? Buyer and seller are related, then also transaction value is acceptable. How? You have to again demonstrate that this relationship has not influenced the price. Now, if all these conditions are satisfied, you accept your transaction value as the value. But if any of the above conditions are not satisfied, that is, your value cannot be determined by Rule 3 of the export valuation rule, then you have to proceed to other rules 4 to 6, and again same rule, it has to be proceeded in sequence. Now what is Rule 4? Rule 4 says that if value of your goods is rejected, you try to find out whether goods of like kind and quality are exported at or about the same time to other buyers in the same destination country to which your goods were sent, and whether they are exported in the same commercial level, quantity level, etc. So first preference is try to find out whether same to same goods what you are exporting, somebody else is exporting about the same time and at the same commercial and quantity level. But many times students, as you know, keeping so many filters is very difficult. So you will never find such a goods which is exactly matching your goods, which is to the same country of export in the same quantity at the same commercial level and all things at the same time. So if I'm exporting on 1st August, you should find everything in the other transaction on 1st of August only. This is highly impossible. Hence, the rule also provides a relaxation. It says that in case you do not find everything same to same, then you can take those goods which are having difference in the dates of exportation. So they are either some days before or after your date of export. Okay. Second, are having different commercial level transactions or are in different quantity level. Okay. Or even there can be difference in the composition. So my goods are made up of something, your goods are made up of something. There is some difference in the composition, quality and design. But most important, all these things do not affect the functionality and use. Both our products are commercially interchangeable. And last, difference in the domestic freight and insurance. Why? I may have adopted flight, you may have adopted sea route. I may have sent to from the Bombay port, you are sending from Chennai port. So these things may create a difference. Now they are saying no problem. Even if you find a transaction which is of goods of like kind and quality, but maybe difference in any of these things, no problem. You take their value and make adjustments. Now these adjustments will be as per relevant factors, which will help you determine how much the difference is created because of change in these factors. Find out that difference, adjust that difference in that price so that that price becomes acceptable for your goods. Now, if rule 4 fails because you are not finding a similar transaction at or around the same price, then they say no problem, apply rule 5. What is rule 5? Rule 5 is the computed value. Now, again, it is the costing value. What you have to do is you have to give all the records of your costing, whereby the cost of material, production, everything will be counted, plus charges for design and brand, and plus charges for profit margin. When all these things are added, it will become the assessable value as per rule 5. Then come rule 6, which is the residual value. Now, if your above method fails, that is your transaction value of the goods of like kind or quality, and computation value. If all these fail, then you come to the residual value. What does this value says that you find out the value by judgment. But this judgment cannot be a vague judgment or baseless judgment. You have to determine the value using those means, those principles which are consistent with, sorry, which are consistent with your uh, valuation provisions. So whatever the valuation provisions have provided, adopt them, try to use the same principle, same logic, and then applying the same principle, same logic, you can take a judgmental value. Now, however, what cannot be taken under this judgmental provision? Local market price of these export goods cannot be taken for determining the final valuation. So in short, you need international price only. You cannot take your own country's domestic price of these goods. Next comes declaration by exporter. Again, this was same in import valuation. So the exporter has to give a declaration stating that all the details provided by the exporter are complete and they are accurate. Again, the power is given to the officer that despite of the exporter giving the declaration, the proper officer may still reject the value of the exporter, that is the transaction value, if he has reasons to doubt the truth and accuracy of your transaction and whatever figures and details you have given. If he has doubt about that, he will reject your value. Now, the moment he exercises the power under Rule 8, the law says we will deem that your transaction value is not determinable under 3. So you have to go to other rules, that is 4, 5, 6. Now, what is the relevant date for determining the rate of duty and tariff value of imported goods? So first, where the goods are to be cleared immediately, that is, you are filing the bill of entry, which is for home consumption. Then what is the relevant date? The date is later off. The date on which you have filed bill of entry or the date on which your ship was given the entry inward permission, whichever is later. Second, if you are clearing the goods from warehouse because you had originally opted for warehousing provisions, so at the time of import you did not clear it, you shifted the goods from there to custom warehouse, and now after a few months you are clearing the goods from the custom warehouse. In this case, the second bill of entry which you will file now for clearing the goods from custom warehouse, the date of such second bill of entry will be applicable. And in any other case, it is a date of payment of duty. Similarly, what is the relevant date for determining the rate of duty tariff value in case of export? So, where the goods are to be exported, the date on which the officer has given the let export order, that is the relevant date for determining the rate and value. In any other case, it is the date of payment of duty. Now, student, comes a very interesting situation. Again, if I have to compare this with GST, in GST, we have a concept of composite supply and mixed supply. Here, they are using the term set of articles. So what is set of articles? Let us say you have imported compass box, so which is a steel compass box, but it is an entire set where all the things in the compass box like the rounder, the D, the triangle, the scale, pencil, rubber, everything is imported and all this is with a single price. Now, where you are importing the entire compass set, let us say for rupees 500. Now this 500 includes the box, that is a compass box value, plus the value for rounder, plus the value for pencil, plus the value for the D, everything. Now in this case, how will you find out the duty, customs duty, when the import is happening of set of article? So what we were calling over there as composite and mixed supply, that is you are supplying two or more things together as a package. Here they have used the word set of articles. Now, these articles are liable to different rates of duty, then only there is a problem. If all are liable to same rate of duty, we have no problem. We'll take the 500 value multiplied by the rate, which is the common rate. But if that is not the case, then how do you find out the customs duty? So in this, they say first check, is the custom duty on your goods leviable on the basis of quantity? That is, there is specific duty and not ad valorem duty. Now, if it is specific duty, that is a duty is to be computed not on the value, but on the physical characteristics like quantity, weight, length, etc. Then simply you can find out the duty because the duty is on the basis of units and not on the basis of value. And you know the units in each compass. Second, where your article is liable to duty with reference to value. Now, the whole challenge is where there are different rates of duty for compass box, for pencil, for rounder, for D, for scale. Now what you will do? Again check, is there a single duty rate applicable to all? If yes, no problem. We'll take that single rate. But if there are different rates of duty, then what you will do? They have simply said, take the highest rate. So somewhere you can say, if I compare it with GST, they are adopting the principle of mixed supply over here because they are saying, take the highest rate and multiply it by 500, which is the value of that compass set. Now, there is a possibility that out of these different items in the compass box, let us say the pencil is exempt. However, you have no choice since you do not have the breakup of the value of 500. the pencil will automatically get chargeable to duty, at which the articles liable to duty with reference to value are charged. So in this case, that pencil which should have been exempt, but since you do not have the breakup of the value, the pencil will be charged with the highest rate. Next is, many times you import the accessories or parts of some machine. Now, if you are importing the accessories or parts along with the machine, that is at the time when the machine is imported, at the same time, you are also importing the parts or accessories of that particular machine. Then how this will be taxed? So for this, they are saying if it is imported at the same time along with the machine, that is along with your main goods, then it will be chargeable to the same rate of duty as is applicable to your goods. So these spare parts may have a different chapter of classification. They may have a different rate. However, if they are imported along with your main product, then these accessories, parts, etc. will bear the same rate of duty as is applicable to your product. In other words, you will not value them as spares or as parts or as independent item. You will treat them as part of the composite supply where the main supply is the machine. So the rate of machine will also be applied to these accessories and parts. But what is the main condition for doing this? The condition is if they are compulsorily supplied along with that article and no separate charge is made for such supply and their price being included in the price of the article. So again, if you check, this is something like the concept of composite supply. So you are supplying the goods, there is a single price, and at this single price, there is no breakup of this price. And at this single price, you are importing the entire machinery along with its parts. In such cases, the loss is if it is imported along with the parts and it is such that it has to be compulsorily supplied along with the machine. So many times, like let us say, we're importing a machine which is a cutting machine. So for cutting, you'll require the blades. Without blades, the machine will not work. So in such case, the blades have to be imported along with the machine. And finally, the main point is the value of this blade is included in the value of the machine. Then in that particular case, you will apply the rate of machine to the spare parts. Correct? The students, with this, we have completed the valuation chapter and we have completed all the 4 chapters which we were supposed to do today. Yes, I could not take up the questions, but that you can definitely practice at your end. And for any queries, you can connect to us. So with this, thank you, students. Thank you for being present here. I'm sure today's discussion would be very helpful in revising the entire topic, these 4 topics. So kindly study, refer the entire module, study the entire module, solve all the questions in the module. And also most important, kindly refer to our exams, past exam papers, and the MTPs, RTPs. These are all available with you on the BOS portal. Kindly do make the best use of this so that you are having the best opportunity of scoring the highest marks. Fine. So with this, I conclude my today's session. Thank you very much and good night to all of you. Yes, Ashok ji, thank you very much.